Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our attention jumps to the unravelling situation in the US of A. Renowned for global leadership, they've once again jumped to the top of a less than ideal leaderboard as the highest case count and mortality due to the coronavirus, with plenty of daylight between first and second country. As the world watches in trepidation at the internal turmoil surrounding the obvious mismanagement of the virus by the Trump administration, and with an election looming, the US-China trade war has now suddenly come back into the limelight. Here to pull apart today's theme, Trump reignites trade war to deflect US COVID woes, I'm joined by our Chief Strategist, David Llewellyn-Smith. G'day, David.
G'day, Tim.
Also on the line, we have, of course, our Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Fantastic. And just a quick reminder that before we get started, to subscribe on YouTube and click the notification bell to be notified of when we go live or have a new webinar to watch, and follow us on your preferred podcast platform. And for those listening in live today, head on over to nucleuswealth.com/webinar and leave any questions in the chat box below the video to have them answered along the way. So with no further ado, we'll jump into the agenda for today. So we're going to be looking at the rhetorical virus war that's underway. We're going to be looking at the US election, running through the world of demand deficit, looking at whether, or asking the question as to whether this is a Great Depression rerun, and then of course summing it all up through market implications and how we use these themes to invest every day here at Nucleus Wealth and the MB Fund. So with no further ado, let's get started. And David, I'll hand over to you for our first slide, rhetorical virus war underway.
Thanks, Tim. We've seen the US and China trading blows now for a couple of months over the virus, mostly rhetorical so far. It probably began when China's wolf warrior diplomatic corps, maybe a month or so ago, perhaps 6 weeks, started putting around the rumour that the US was actually responsible for the virus, and in particular a Marine who had visited Wuhan had somehow seeded the virus in China. And that led, quickly into a mushrooming back and forth with, Trump describing it as the China virus. Excuse me, and then that has now exploded into just a daily tit for tat of escalating rhetoric. And I just wanted to give you a quote from last night for how extreme it's become in the US. Donald Trump last night said, "We went through the worst attack we've ever had on our country. This is really the worst attack we've ever had. This is worse than Pearl Harbor. This is worse than the World Trade Center. There's never been an attack like this, and it should never have happened. It could have been stopped at the source. It could have been stopped in China." Obviously there are historical resonances there that are very extreme. We take these things with a bit of a grain of salt with the extravagant rhetoric of Donald. Nonetheless, he is tapping into and inflaming a mood, a very angry mood in the US.
And at a certain extent, you have to sort of, as much as you can, you sort of say, "Oh, well, it's just Donald being Donald," but in the end, he is the president of the US, and so you need to.
That's exactly right. He's lined China up here with Imperial Japan and Al Qaeda. So we have a new axis of evil, if you like. The rhetoric is very extreme. It's run through all kind of different avenues. We've had lots of allegations of where the virus came from, the Wuhan lab material, of course, and then on the other hand, you've got China going just as hard, smashing anyone who even looks at examining where and how the virus did actually evolve out of Wuhan, and clouting the US every time we see this kind of rhetoric. So Right now, there's extreme saber rattling going on. And we've seen a little bit of action as well. There's been some new export controls on semiconductors in the US. They've mooted some prevention of financial flows from government superannuation funds into Chinese assets, which obviously spooks the market to the extent that it might move into a sort of wider boycott. And last night we saw, Trump really lining up his China trade deal as well, and giving China basically a 2-week deadline to meet the conditions of the deal, which they have absolutely no hope of doing. In fact, they were probably never going to do it, even when the deal was signed. It was a very extreme commitment to buy a lot more US product. We've got a chart in there of how extreme. It's a rise, a very, very big rise of over $100 billion in US purchases. And right now, of course, their own economy is struggling a great deal. And so they simply don't have the demand at home to even do these things. And it's such a massive number that they're not going to be able to divert either. So China's the benchmark Trump has set for China is one that it has no hope of delivering on. So he's basically set himself up a trigger where, if he wants to, he can pull it, and the entire, China trade deal that we saw laboriously negotiated in the second half last year could unravel. So, I'll just make the point here that this is so far rhetorical, and we haven't seen these things happen, but, sort of setting up a political narrative, it's pretty worrying stuff. So what's driving this in the US? Basically, Trump has horribly mismanaged the virus. He was skeptical of it as it arrived. His shutdowns were half-hearted. He's encouraged states to stay open or revolt against shutdowns at times. And that's resulted in the worst outcome of any country on earth for the virus to date, obviously with both infections and deaths. And, although it's moving into summer in the Northern Hemisphere, as states try to open up, there's a lot of states there that has simply not flattened the curve. And we're going to see increasing virus activity along with increasing economic activity over the next few months. So Trump has a major issue on his hands in terms of the US election later this year, when he's basically, I would have thought, committed political suicide with this virus mismanagement. If, for instance, Australia had done something similar, a scale of blundering of this nature, I would write the government off, whoever it happened to be. I think that this is, a government that can't protect its own people is a dead government. So, this means that he's got to find a scapegoat, a very big one, a very loud one, and a very hated one, or that the responsibility for that mismanagement is going to land squarely on the administration. I've got a couple of charts up there. Firstly, it shows that the Trump approval rating has been slipping over the last few weeks after it kind of got that run to the flag boost as the virus started to take off. It's sort of somewhere just below levels where he actually got elected, so it's not disastrous yet, but it's kind of his approval rating stalled out and going the wrong way. And so, this scapegoat obviously is going to be China, and it's fertile ground. Recent polling has been showing that the American attitudes towards China have deteriorated extraordinarily. They're now much worse than they were during any of the trade war. Moreover, they are bipartisan. I've got one poll result recently from Harris with about 90% of Republicans who see China as to blame, and it's even 2/3 of Democrats see China as to blame for the virus. So this is extremely fertile ground for him to run an anti-China election campaign.
And he's got quite a strong part on that in terms of he, especially given he's up against Joe Biden, who's basically saying, well you were the one that let them into the, and gave them all these things. So 8 years you spent as vice president and gave away the farm and let all these American businesses go overseas, on the basis that China would actually open up and liberalize, and they did none of it, and you let them keep going. So why can we trust you? Yeah.
Absolutely, and gave away the South China Sea as well. Yep. While Obama and Biden did nothing, they built all of their, in situ aircraft carriers right around the place. So yeah, I mean, the Democrats' history on China is much weaker than Trump's is, and so it's a very, very obvious political wedge to play, and with all of that anger in the electorate. As I said, fertile ground in which to do it. So, I mean, I think at the very best, we can expect this escalation of rhetoric to get worse, not better.
And I guess I'd also say if the if Biden does get past Trump on it, then he's not going to be running on a platform he's not going to be running on the opposite platform. He's not going to be running on a platform of saying, no, let's be really nice to China and that'll fix everything. He'll be running on potentially even a harsher one to make up for the fact that they didn't do anything.
Yes, that's right. I mean, I think Trump is better placed, but obviously Trump's agenda is going to set the agenda of the election, and so the Dems will need to be tough, but I think they'll struggle to be as tough, at least in a rhetorical sense. The question is, of course, does that rhetoric turn into policy? Now, to some extent, I think it will have to, simply to give some ballast to the rhetoric. And, we're certainly going to see things like pushback on, the critical supply chains, certainly attempts to reform on health, and pushes for more and more investigations of China vis-a-vis the virus. So we can expect that's all kind of baked in. But the issue is, does it actually scrap the trade deal and or end up in even higher tariffs or other forms of punishment for China, which might include financial flow boycotts, etc. So if we just skip over to our next chart here, this is the kind of macro underpinnings of why this is likely to it's a basis upon which policy may be necessary to actually match the rhetoric. And that is like coming out of the virus, even during the recovery, we can expect the world to be in a state of serious demand deficit. Basically, everybody everywhere is going to be rebuilding buffers, all the private sectors, the corporations, households, SMEs, etc. They've all been shocked, had the life shocked out of them, so we can expect everybody to be saving for a rainy day and rebuilding buffers just in case, something similar happens again, especially given, it's a very indebted world. And that leads you partway into a context of ongoing secular stagnation, in fact, intensified secular stagnation, depending on how much fiscal policy responds. But, this will mean that various governments will be looking to externalize this weakness wherever possible via falling currencies, and we've already seen this post GFC. We'll just see more of it, which obviously will mean lots of QE and various other debasement strategies for currencies, and of course it gives you the rationale for tariffs. So, there we have both a rhetorical, a political, and a macro kind of driver for a resumption of trade war. And so, if we move across to our next slide, which is where it starts to get quite serious, is this a Great Depression rerun? I mean, everybody knows the old story of the Great Depression basically starting as a demand shock, but ending as a supply shock as trade collapsed through Smoot-Hawley tariffs, etc. And I've put a chart up here from Charles Kindleberger, who sort of wrote the defining text on these.
Actually, David, it might be worth just for listeners just giving a little bit more context to that. So basically, as David said, what started as a demand shock, then factored into one-upmanship from countries where every country was trying to protect its own backyard, and they all started erecting these trade barriers as time went on to try and each time somebody put one on, the next country would then go and put a higher one on in retaliation and so on and so forth.
Yeah, quite right. Now, if you read the defining text on this, which is World in Depression by Charles Kindleberger, he outlines a history to what transpired in the Great Depression that's incredibly similar to what we're seeing today. That is, through the 19th century, we had this huge globalization pulse kind of coming out of the British Empire. And the British economy, much like the US economy has been in this century, or a lot more the last and the early part of this century, was the economy of last resort. So if the British economy was weak, capital tended to flow outwards and stimulate the rest of the empire. Then they would start sucking in British imports, which would improve things at home, and then vice versa. If the home economy was, sorry guys, can you hear that?
That's all right. Keep going.
All right. Conversely, if the home economy was strong, then it would suck in, lots of imports and keep the global economy strong. Now, that's just a 100% analogy of the way the US economy has worked over the last several decades. The problem is, at a certain point, what happened coming into the 20th century. Sorry, guys, I've just got a bit of a child revolution here. Let me just put it down, and I'll.
Yeah,
that's fine.
So let me take over from that. But so I think the key bit was really that you've got this. So you've got this one great power sort of that's sitting there in terms of it wants to be. It doesn't want to be the economy of the last resort anymore because it's built up this huge debt burden. And so we're talking, say, about let's say we're talking about England initially, and so they didn't want to be running the one that had to keep running massive deficits in terms of being the demand driver of the rest of the world because they'd just built up so much debt that they could no longer afford it to be. And then the rising great power that in terms of the US, it doesn't want to be the economy of last resort because of political issues. And the US, the analogy with US and China is actually very, very similar in terms of the amount of, there's a lot of allegations of intellectual property theft from the US in the early 1900s. They're a huge exporter of their goods, and so absent the political system, it was a very similar dynamic to what you're seeing, and so. Then you roll that forward into today's terms, and you have the same thing where the US doesn't want to be the economy of the last resort with its debt burden, and you're facing the same thing in terms of China is not interested in picking up and becoming, actually being an importer and actually being the world, the driver of world demand, owing to its political issues and other factors as well. And so that's where you get caught in this whole trade war, where you just get the tit for tat, and each side then wants to, the fading great power doesn't want to lose any more of its trade, and so it starts erecting trade barriers, and then vice versa. And that's this graph we can see on the right, which is showing you, the spiraling inwards. So as month went, each month passed, you would get just less and less world trade. Every single month until you sort of spiraled in towards that, basically towards zero, I suppose.
So, Damien, I guess, like casting your mind back then to now, though, when you're talking in trade, there's obviously been a hollowing out of things like manufacturing in a lot of countries where you sort of almost have to, like I'm just perhaps using just Australia as an example, where it's like, well, we've only got one choice if we want to use the equipment and tools and everything is, there's that sort of centralization of manufacturing an issue now, or would that potentially smooth it perhaps a little bit because there is sort of a minimum level of trade required, otherwise the country would just stop until it could build its own stuff?
Look, I think the stuff that China makes generally isn't particularly complex to make, and the formulas are well known, and it's more of a matter of scale. And I guess the question comes back for a lot of these is saying, well, okay, it's great that you can buy a cordless drill for $20, $30 for a cheap cordless drill, but if you actually had to pay 50 or 60, would it be a massive impetus? Would that suddenly mean the economy ground to a halt? And I don't think that's the case in a lot of these. I mean, it's obviously not going to help, but
no. But what it does do is obviously lower your income. I mean, your effective income, because you've got $40 less to spend on something else.
Yes.
So it does slow your growth.
Yeah.
But, and let me just apologise. I'm back now. My 4-year-old isn't too happy about the great power dynamics either. So anyway, so carry on. Yes, or shall I take over?
Yeah, you go.
Yeah. So you've more or less explained the dynamics that lead to various constraints on trade. So let's flip over and ask what the market implications are. So there's a lot of impetus for the China trade deal to run into serious trouble. It's quite possible we see even higher tariffs as well, but those things aren't certain, but they are becoming very material risks. So the first kind of cab off the rank on this is a strong US dollar. Not necessarily on actual tariffs, certainly if we get them, but possible tariffs and rising risk of them is enough, and that will be driven by the intensifying rhetorical war, which is going to get worse as we get close to the election at an absolute minimum. So if we have a strong US dollar, in this demand deficit world that's struggling to recover out of the virus shock, that's very different to the kind of environment that we would usually see in a global recovery. Normally we would see, the Fed finally does enough and the US dollar starts to fall, and that starts to reliquefy the entire global economy, and borrowing costs start to fall in marginal economies and emerging markets, etc., as the US dollars start to flood out of the US instead of in, so at this point it's probably too early to say either way in terms of a recovery, but the threat of this escalating problem with China, if it keeps the US dollar strong, it's going to make it very difficult for a lot of the peripheral economies in the globe to recover. That means they'll have higher capital costs, higher interest rates and borrowing costs, and they'll already be struggling with a Southern Hemisphere winter virus shock. So what that adds up to is you get no GFC recovery rerun. As you recall, in the GFC, what I just described is exactly what happened. Eventually we had enough from the Fed, and China was stimulating like a mad thing, and so capital just gushed out of the US and went to anywhere peripheral for a better return, including the Aussie dollar, which everyone will recall, as we were benefiting from the Chinese fiscal stimulus. But that dynamic's simply not going to happen this year with this kind of geopolitical setup. And so that's a huge headwind for any kind of V-shaped recovery. Makes life extremely difficult for commodities as well, being priced in US dollars, but also because so much of commodity demand is in emerging markets, as well as supply for that matter. So that helps, or rather hinders, any peripheral recovery driving global growth as well. there may be.
Just to put that into context, to break that down. So I guess if you used, say, iron ore as the example there, priced in US dollars, and if it's at a whatever $85 price, and the US dollar goes up 10% versus China, now that the price of iron ore in China is 10% more expensive, or in Malaysia or Brazil or wherever. And so it's that issue about if you need to import that iron ore, then that's obviously a bad thing for you in that country, because it's just got that much more expensive. What generally happens is the commodity actually comes down the US dollar goes up 10%, the commodity goes down by 4 or 5%, so that there's sort of it's like matched out off to a certain extent. That's based on it.
Yeah, and that's right. I mean, I am actually toying with the idea that iron ore might be the exception this time, simply because, as a quick diversion, it looks like China's so out of growth drivers that it's simply going to have to press the panic button on empty apartments again. I don't think that this is an imminent kind of boom for iron ore, but it might keep it a bit firmer than I'd originally anticipated for the year ahead. But that's by the by. So you've got a world that just is very much struggling to recover, already made much more difficult by the strong US dollar, and then you'll also have this big push against Chinese supply chains, which will also damage growth. And so you're looking at a really tepid kind of global recovery, at least for this year. And so you've got to ask yourself, are stocks priced for this outcome? There's some good news in that as well as bad. I think we've seen stocks already starting to struggle as these kind of dynamics dawn on the market. They haven't really gone anywhere for 3 weeks or so after the rocket rebound, or the crash up, as we like to call it. The good news on that front is that Trump's obviously gone very strongly on measuring his presidency using the stock market as the number one benchmark. So he doesn't want to push too hard and crash the stock market. So he's on a kind of good behaviour bond with the stock market. And there's one reason to think that the war, it will be something of a rhetorical war or a faux war with the US and China. But the problem is, if Trump's still facing all of these difficulties with the virus and the blowback from that, and he gets a lousy recovery anyway, then it's kind of all bets are off for how hard he goes in on China, and therefore the difficulty faced by the stock market. Inflation, just forget about it. We're already into a massively deflationary shock in a massively deflationary world. And then if you add a strong US dollar to that, then it's a pure deflationary environment. Nothing to worry about.
Well, and I guess there's parts where you say, this type of environment, especially when you see the trade tariff barriers lifted and lots of changes in supply chain to sort of bring supply chains back to countries, and plus all the bits about adding some more fat into the supply chain. So that is generally everything else being equal, that's generally inflationary. It's just that for our part, that means rather than being a big part of deflation, it might just end up being a little bit of deflation.
Yes. There are always inflationary things going on. It's just that I think they're going to get swamped.
Yeah, and most of the trade war is inflationary. It's just that
absolutely,
the deflationary pressures are so much larger that
exactly
it pulls it back the other way. Yeah,
exactly right. And as you and I have discussed before, like, we really don't see a lot of that repatriation of supply chains as being labour driven. Like for it to be viable, it's likely going to have to be heavily automated anyway. And so, there may be some inflation in some of the capex costs, but it's not going to lead to any kind of wage push inflation, or, it doesn't really do a great deal for you other than your kind of sovereignty.
No, that's right.
And certainly doesn't do that much for inflation, even if you are repatriating, if you're using robots. So, the direct implication for all of these things is the Australian dollar is no place to be. Obviously, in terms of rhetorical or, actual trade war between the US and China is a very, very Australian dollar negative for obvious reasons. Us being, conducting the impossible straddle between the two, it may result directly in some of the threats that we've seen becoming real, where China actually bans its tourists or students.
Actually, just probably worth giving a little bit of prelude to that, just sort of say that, so this is a Chinese ambassador has made relatively unsubtle threats that tourism, education. What else? They have there's something else on there, wasn't it? Tourism and education were the big ones. What was the other one, David? They were threatening.
It was tourism and students were the main ones. Oh no, there are a few. There was beef, I think,
right?
And wine, and beef and wine, but
not, specifically not commodities. Was
yes, that's right. Well, they're already pressuring commodities where they can. They're definitely pressuring coal, but they simply can't afford to pressure iron ore, so that'll be fine. It basically all adds up to a very difficult environment for the Australian dollar. So I would expect it to remain very weak, and if stock markets do actually swoon at some point because the trade war turns real, then I would think that the Australian dollar would do exactly what it did earlier this year and crash right along with stocks. And the other immediate thoughts that I had out of this discussion was gold, what it means for gold. This is a difficult one. Is it a headwind for gold? Yes, because a strong US dollar is always a headwind for gold. Or is it a problem for gold insofar as if you have a very strong US dollar, would gold fall? Gold actually performed okay during 2019 and the trade wars. So I guess the geopolitical risk helped offset, the strong US dollar. And so it's a bit of a toss-up on which one of those would win in this environment. Certainly, if you have this strong US dollar and these very deflationary dynamics, you're still going to have the Fed pumping away as well. And so despite, the US dollar being strong, the underpinnings of the reserve will be weak. And so it's possible gold would be okay. And so that what we see, or I see as a burgeoning bull market, would probably continue. But, the really bullish scenario for gold is actually untroubled global recovery along the lines very much as what we described post-GFC, where you just simply have the Fed doing enough to sink the US dollar, and gold just gets a big monetary tailwind from all the money printing. So it's certainly a less favourable scenario for gold than a recovery, but it would probably still be reasonably strong, I would guess. So yeah, okay. I might swing over to you, Damo, now.
Yeah, got a couple of questions too, gents. But if you,
let's go to questions first.
Questions first, okay? Yeah, sure. So these have just come through while we've been talking, and for anyone listening in live, nucleuswealth.com/webinar is where we're picking these up from underneath the video. So quick note here, actually, just a comment and a question. Loving the kids in David's background. We're all dealing with similar issues working from home at the moment, so interesting feedback there. Do you see any heightened risk of conflict breaking out in the South China Sea in the lead up to the US election? Thinking of a wag the dog scenario of Trump trying to bolster his re-election hopes, gentlemen.
Well, that is a fascinating question. The first thought that comes into my head is I was reading last week that currently the US only has one serviceable aircraft carrier globally, because all the rest of them have got the virus. And that's 21 aircraft carriers that they have.
Wow.
Right now is a terrific time if you want to flip that on its head for China to invade Taiwan, if it wanted to. The US would struggle to mobilize enough forces to fight it off. No, that's no laughing matter, of course, but I don't think it's going to happen. So that gives me a giggle. And I guess that's the point, really, is, this actually was an opportunity for China to invade Taiwan, and it didn't do it. So does it really want to? Or it just feels like it's not strong enough yet, or, it's got other things on its plate and it's not worried about it. Enough domestic unrest to bother. And so, that calculus then applied to the US, I don't think so. I don't think you would, I don't think look, if you're hesitating to go to trade war because you're worried about the stock market and you're kind of, on this tightrope of trying to be strong enough to win the election without being so strong as to unravel your own liquidity-driven then would go straight to kinetic war, because you'll obviously crash everything in sight with a perhaps a gain. But I mean, there are a lot of steps between strong rhetoric and any kind of kinetic war in the Straits. So I wouldn't expect something like that, no.
Yeah, but the danger is that Trump decides to do something small and then China steps back, and then Trump tries to do something a little bit bigger and China pushes back, and then Trump pushes China too far.
Look, there's always a risk when you get this red hot rhetoric and when the public is on board with it, and the blood is up in a country, there's always a heightened risk of things spiraling beyond anybody's preconceived plan. And you can stumble into conflict. Absolutely. It's higher risk than normal, but I would certainly see it as a tail risk, and moreover as an accident rather than a plan.
But the other thing is, we've focused a lot on the US in this discussion, and we haven't really spoken about the Chinese political constraints, which are sort of similar in a way, in that you've got you have them there trying to they've obviously suffered a blow to their legitimacy as well, in terms of their basic pact with the people is, we won't give you any freedom, but we'll look after you and sort everything out for you. And given they haven't, they've obviously got to working up a bit of nationalism in China is important as well on the other side.
Yes, it is, absolutely. I mean, their own public are blaming the CCP.
Yep.
So, yeah.
Interesting. One more question too, gents, here from avid listener I know. I've seen this name a few times, Stephen F. What are the indicators used to separate whether this is just a recession or is now a depression, great or otherwise? And even if there is a differentiation between the two, does it matter?
Well, I would argue we've been in a form of depression since 2008.
What about the country, though? No, sorry.
Not an official one.
No, not an official one, but an income one, in effect. I mean, if you measure, things like, household income measures, then the slump that we saw in the Great Depression and then recovery is now above where we were coming out of 2008. Now, obviously, it fell first and then rose, but we've had what is effectively an income recession going for a decade, depression going for a decade.
Well, so depression's usually 10%. So
look, so it's flat rather than.
Yeah, I think if you call it a great recession, you'd certainly be.
Fair enough. Yep. Yeah. Okay, so what would make it a depression? Well, I mean, I guess you could say that the GDP shocks from the virus are depressionary, like they are of that scale, 10%.
Yeah.
And so you'd have all fairness in calling this it will effectively be a depression in historical terms.
Yeah, and the other one's unemployment is a big one. So
Yes,
like Australia often picks on the on GDP as being like its only measure of whether you're in a recession or not. But yeah, other countries look at a range of different measures in terms of manufacturing output and employment as being key.
Yep.
And yeah, by the employment measure, you'd say yes, it's a depression.
Absolutely, and I mean Goldman was out last week saying that if you accepted JobKeeper, then Australian under and unemployment was already around 24%. So I mean, you wouldn't get any argument from anyone that that's not depressionary. And so, those are the kind of measures that I guess would call it a depression. In slightly less formal terms, though, I think I'd go back to that discussion we have where we just have this demand deficit going, and that's those are depressionary dynamics, basically. Secular stagnation, etc. And if it does result in actual trade war, then you will those depressionary dynamics will intensify.
I mean, and the other part is we haven't gone into it today, and there's a whole topic in itself. Is that what's called a balance sheet recession, where the leverage and the structure of people's liabilities actually means that even though the numbers might not look as bad, there is a bigger recession happening in terms of that. And I think there's a pretty good argument for that even if we didn't have this going on, that a balance sheet recession was certainly odds on as well.
Well, if we go back to those charts we had earlier from Deutsche, which in the demand deficit section, they show the crisis is moving from liquidity to solvency, and so bank balance sheets are in for a depressionary shock.
Yeah, and what David means by that is liquidity side is saying, well, I'm fine, except I just need, I haven't got cash right now. It's still coming in. I'm waiting for my customer to pay me or whatever it is, and once that cash gets in there, then everything's fine. Whereas a solvency comes into, well, I'm making a loss, but I'm not even sure how I'm going to get out of it, and so the companies they're going to go broke because they genuinely don't have the demand, and as opposed to companies going broke because they just don't happen to have cash on hand at the moment because it's all tied up somewhere else. And so that's where, and that's the hardest part for, we've obviously seen central banks step in and do lots of lending and lots of support to markets, which is good because it means they've solved the liquidity issues, but the solvency ones are much harder to manage.
They are, and the nationalisation of capital markets has probably saved most corporations from tipping over that ledge, but the real problem's in the SMEs where they don't have access to capital markets. That's bank lending was where they get their funding, and they're all facing, tightening standards and difficulty rolling over, etc. So, that's where you'll see your balance sheet recession.
Yeah, and that they tend to be sort of 60-70% of the economy tends to be in that area of the market. So yeah,
they do. Yes,
it is not an insignificant part of the market. The listed part is actually much smaller.
Very good. Attention turns now to I guess these themes in the portfolios. Damien, maybe a bit of insight on what's been happening with us.
I mean, I think the market implications there were that David ran through were sort of follow up what our expectations are.
Yep.
The issue for us is then, do you try and chase markets higher? And it's a discussion we've been having. If central banks go in and just buy everything and start buying, like the Japanese central bank does, is out there buying equities even. Does that mean that you can't fight the Fed and all assets are just going to keep getting pushed up? And it's a genuine concern you can have in terms of saying, will will there actually be so much money that you just don't even worry about valuations, don't worry about the falling profits and losses of jobs and loss of demand because the Fed will just keep spending money and keep bailing you out? Versus the part about saying there's various options you have, and one of those options is cash. And if cash is going to give you a 0% return, then that might actually look attractive if you basically, I guess what we've been looking at buying stocks. I think the US stocks there for a while got to, and they're probably on about 25 times earnings, maybe a little bit lower now. But just to put that in context, you're basically getting a 4%, return on earnings, which is sort of less than a 2% return on your dividends, with a view that you can lose. You can wipe that out in a day's movement. If you're getting a 4%, if you're saying, yeah, I'm getting a 4% return, but stock markets are volatile, all that, and they do go back to their long-term averages, then you're going to lose almost half your valuation on that. So we've been of the view that the markets are pricing in a V-shaped recovery that seems to be very unlikely. If it does happen, there is a V-shaped recovery, then markets have already priced them in. So we don't think we're giving away that much by maintaining some conservatism in our asset position.
Mm-hmm.
But on the flip side, if it doesn't come back with a V-shaped, and I mean we're not the only one out there suggesting that this recovery could be a lot longer. Then there's plenty of downside that you want to hedge yourself against and you want to avoid.
Okay. Yeah, fantastic. All right, very good. Well, look, no further questions there. Any final thoughts, gents, or we can sign off?
Dave?
Everyone happy?
Yeah, no, that's fine. Yep. Sorry, I thought you were checking if there were questions.
No, that's all right. Yeah, I was just looking through. But so look, yeah, thanks very much, gents, for the time today. Finished nicely on time as well, which will be great. Thanks for everyone tuning in. Thanks for the guys who popped through the questions. And if you are listening to this, obviously post-show, you're more than welcome to check us out live and, of course, participate along the way with those live questions in the box at nucleuswealth.com/webinar. So on that note, we'll catch you at the next one. Cheers.